Jean-François, I'm very happy to have this moment, this privileged moment with you, fireside chats. We know each other for a couple of years now, and do I know you enough to ask you this? Can you be really trustful and give us all the truth and everything you know about this macroeconomic outlook?
I swear, I'll try.
That's great.
It reminds me of something I used to do, is to visit the Central Bank of Russia, good old days. And every time I was visiting, they were saying, okay, last year, your top 10 recommendations were this, wrong, that, right, this, right, and so on and so forth. So I need to have some credibility, so as much as possible, I will try to say the truth, yes.
That's great. Well, we all know we're living in very challenging times, as everybody knows again. According to you, what is exactly going on in the market, except the fact that they are going crazy?
Well, this is probably unprecedented times. It's something we have not seen in decades, once again, for many aspects. A war, to start with, a pandemic as well. But now, talking about what's going on at the moment on the market is probably an inflation-driven story, probably. Inflation not seen like that in the last 40 years. So never before, since the 70s, we have seen such inflation at 9% in the US, 9% in Europe, 83% in Turkey. Well, you name it, everywhere you have this kind of numbers, absolutely unprecedented. So the reaction to that is to see central banks going a bit crazy, but they have to catch up, to be maybe they were a little bit behind the curve. And the result of that is the end of 40 years of decline in interest rates. So this is a brand new world. The negative rates were a brand new world, but now this is a totally different story where we're going to live in a rising rate environment, something we have not seen in the last 40 years. So this is something probably big, and the market is adapting to this new regime quite violently. I don't know if you know this saying. We used to say, you buy bonds to dream, and you buy stocks to dream, and you buy bonds to sleep. Well, none of that is happening, because if you buy some bonds, you have a total return or negative of 16%. If you buy a typical asset manager, 60% of bonds, 40%, 60% of stocks, 40% of bonds, your total return is down by 22%. The last time we have seen that is 1931. So this is unprecedented times. The reshuffling is the rebalancing towards something very different compared to the last 40 years. So this is probably inflation-driven than the central bank. And to finish with, clearly what we have seen the last few days, yesterday it was amazing. You have a very poor number. ISM in the US manufacturing sector is going down. This is a very bad news for US economy. Probably a recession is waiting for us there. What the market is doing, stocks are going up. So it shows very much that the rates environment is leading the asset class, the other asset classes. So like Anne-Christine said, probably infrastructure is the decorrelation is very interesting in this world, because you have this risk-on, risk-off environment where the rates are leading the rest of the asset classes.
Well, we will talk about inflation a little bit later or so, but what are the respective roles of central banks and also governments?
Well, you have obviously central banks catching up this inflation. They have no alternative but to high rates like never seen before. And since the 70s, we are in a Volcker moment almost everywhere. I think of that 3 weeks ago. On 1 week only, you have 600 BPs of rate hike by central bank, by major central banks. So something totally unusual. Usually it was a step 25 was a regular step by any given central banks. Now it's 50, if not 3/4, if not 1 full percentage of rate increase. So clearly the central bank, for me, are center stage in this thing. And there is a big difference between Europe and the US here. In the United States, you have the central banks hiking rates. Once again, like never before since the 70s. You are going to end up the year probably around 4.5%. We are coming from 0. So this is a big increase, and not the level, but the speed at which central banks are increasing rates. Again, unseen in the last 40 years. So you have the central banks hiking rates very significantly in the US, and at the same time, the governments in the US is as well pushing on the stop pedal like never before. Again, the deficit reduction in the US is a 9-point reduction of deficit in the US compared to last year. That's something we have not seen since 1946, this deficit reduction. So a totally different story compared to Europe, where you have a central bank starting later, doing smaller things, and at the same time you have the government. In a way, you have the central bank in the stop pedal, and you have the government in the gas pedal. So something has to give. In Europe only, you have probably around 300 billion of public spending since the start of the invasion of Ukraine. Think of Germany, 200 billion of spending from Germany. Who could have thought of that? On top of 95 billion already pledged. So we are talking about 4-5 points of GDP of spending by the German government. So en passant, you can say that those who are calling for a huge recession in Germany, if you have 5 points of the government spending, it's going to be a bit difficult. But there, the policy mix, again, between Europe and US is very, very different. Policy mix is very coherent in the US, so the peak of inflation is probably behind us, but the result of that is probably a recession coming in the fourth quarter. We expect 0 GDP growth in the US next year, close to 0, so stagnation in the US for this very reason. While in Europe, in fact, you have a bit of a policy mix, a bit schizophrenic in a way. You have the central government spending like mad, whatever it takes to save the consumer, and central banks are in a similar position as the Fed. So it's very different situation, but clearly central banks are driving the market, and rates are driving the market, like I said.
What about the energy crisis? Is that the beginning or the end?
Difficult to answer this question. Honestly, it's probably not even the beginning of the end. I think it's a big voyage towards a green transition. We are not going to talk about that because we have an acceleration of history. In fact, because you have the necessity to fight the global warming. And Christine was saying this summer was probably the chillest summer of the next 10 years. We have to do something about that. Otherwise, we're going to die. It's as simple as that. But at the same time, we have to accelerate the green transition because, well, we need to be independent. We have to need some sovereignty in terms of energy providing. So this is probably as well as structural, short term and long run. If I may just add one thing. Probably what's going on, this transition towards electricity. We are 70% carbon fossil fuel economies. We need to go to 70% electricity fueled economies. So in a very, very short period of time. So infra is going to be key. If we want to do that, at first it's going to be super costly. IMF just this summer published a study. Is going to be 6 to 10 trillion over the next decade. So it's a lot, but in fact it's a half point of GDP every year. So it's achievable. We can do this. There is hope. I don't know if it's Star Wars moment, but there is hope. Yes. Clearly, in the short run, it's going to be super costly, probably inflationary. You can see that the Tesla is now is hiking its prices by $8,000, or you see that wind pals is 15% more expensive, and so on and so forth. But in the longer run, obviously, there is no cheaper energy than wind and solar or even nuclear. We are talking about energy at 40, 50 euros a megawatt. So it's much cheaper than the prices that we are experiencing at the moment. So short run, super inflationary, probably. Longer run, super deflationary at the end of the day, and the whole world is investing like mad in renewable energy. So you have some learning curve very fast. I'm thinking about batteries, of wind, of photovoltaic, obviously, and probably it's going to be deflationary at the end of the day.
Well, talking about this energy crisis related to that, let's be pragmatic. Are we going to be cold? As winter is coming, maybe not today, but are we going to be cold? Shall we all buy double blankets and, I don't know, some special heater? What shall we do?
Well, blankets would be better for the planet. But no, yeah, clearly we are, in a way, if I have to summarize a little bit of view, is that we are moving from a Putin-driven energy crisis a weather-driven energy crisis, in fact. In our view, the peak, well, I'm very cautious because of this nice panel that we have here today, but we tend to think that the peak of the energy crisis in Europe is behind us, or we are there. We are going to be okay this winter. Why is that so? The stocks of gas are full. We are talking about 98% in France, 94% in Germany, 92% in Italy. The target was to be at 90% at the end of November. We are 2 months ahead of schedule. So the stocks are full. So the diversification is working because, as you know, the Nord Stream has been cut since the 31st of August, and still we are building up some stock in Europe. So the stocks are full for this winter. Stocks are about 2-3 months of energy worth going forward. So stock of gas are full. The diversification is working for this reason. We are accelerating the infrastructure. I think of LNG. I remember at the start of the war, everybody was saying, well, LNG terminal is not possible to get it before 2-3 years. Just the German has just signed with the Qatari to plug the next LNG terminal in December. So it's a big acceleration of history everywhere. Think of renewable. In France, we are plugging in wind farms that we have never done before. So we have renewable energy accelerating. Photovoltaic in France is up 43% year to date. So it's a massive acceleration of transition. So stocks of gas are there. Diversification is there. Electricity-wise, well, it's difficult to think that the situation of nuclear plants in France can be worse in a way. So we expect 8 more nuclear plants replugged in October, 7 in November according to EDF. We see that German plants are kept open. So in terms of electricity, in terms of gas, I think plus renewable, the worst of the crisis for this winter is okay. The big challenge is for next year because bulk of our stockings of gas this year has been done with Russian gas. So the diversification, the acceleration of renewable, the grid, the connectivity, well, it's up to you guys. But it's depending on the massive investment we have to do in a very short period of time.
So basically, we can't wait to hear you next year, actually.
Well, wait, with tomatoes.
That's a teaser.
The good thing is that tomatoes, we don't have any more tomatoes, especially in Finland, for instance. They just say no more tomatoes, so you cannot throw it at me.
You partially actually gave a response to the next question, but maybe you can add some insights. Prices have gone up and the increases are, well, they seem not to stop. Is the inflation here to stay? And if you want to give some precisions about that.
Yeah, I think it's still a new regime of inflation. There is no question we are not going to go back to where we were before. I think of that. The last decade before the Ukraine war, the average core inflation in Europe was 0.9%. We are not going to get there for many reasons. Like I said, the energy transition is going to take 5, maybe a decade before to rebalancing toward electricity at the very least, depending on many things. But it's going to take time. So this is a transition which is inflationary at first, once again. That's the first thing. Then we see that this is the end of the globalization as we know it. Nobody wants now to take decision in terms of supply chain only based on prices. So this is nearshoring priorities. This is resilience of your supply chain. As think of Apple moving its iPad from China to Vietnam, moving in its iPhone 14 from China to India, and so on and so forth. So you have a reshuffling of globalization. This is the end of globalization as we know it. That is inflationary as well. And probably you can add to that some aging population and so on and so forth. So I think this is not. We are not going back to normal. So interest rates are going to be higher. We are an aging population. We need to invest massively. So obviously, if you want to invest massively, there is a kind of a competition to get investment. So you need higher rates at the end of the day. So this is going to be a different world we are going to live in compared to pre-war or pre-COVID world.
One last question. In a nutshell, if we have to remember last year from this year, what has changed from last year, in a few words?
Well, I think we touch on that. I think what has very much changed is these two things I was just mentioning. This is structural story. The deglobalization, the diversification of supply chain, the regionalization. You can name it as you wish, but this is a very structural new feature of the world economy. The world trade was growing twice as much as the world GDP. This is not anymore the case. So the world trade is not anymore the engine of world GDP. Definitely not. So this is a major structural change to me, and we are here to discuss that. But clearly, the green transition, we need to do that for global warming reasons, obviously. Again, if you've been in India with 54 degrees for 1 week, as you know, the human body is dying at 55 degrees. So we are very close to not be able to live in this planet. So this is an absolute necessity. But on top of that, we have to accelerate in a few months' time the transition towards alternative energy, to gas, to coal, to oil from a major supplier, which was Russia. So this is as well structural, and it's short term and long term.
Well, thank you very much, Jean-François Robin. You said all the truth, I'm sure. Thank you. Great applause to you. See you next year.